Hello everyone. In this session, I'm talking about an article written by Gary Gorton and Andrew Metrick on getting up to speed on the financial crisis. So, as a part of this session, we are going to look at these few topics. What are the triggers and vulnerabilities of the financial crisis? How do you distinguish between a trigger and a vulnerability? That's the first part. Then we'll move on to understand what are the main vulnerabilities of short-term debt that have resulted in the financial crisis. And during the 2008 time frame, when the Lehman Brothers has collapsed, what are the consequences of that failure on the global financial markets? How did the global financial markets respond to the failure of Lehman Brothers? Then we will talk about the historical background leading to the financial crisis, the two main panic periods of the financial crisis, one in the August 2007 and the other one being September 2008. So what are the key similarities and the differences between these two periods? We are going to look at these two main panic periods. Then the various government policies that were implemented during this period, the various policy responses that came out during this period as an after effect of the financial crisis, and what are the short-term impacts associated with each of these policy responses. We are going to talk about them. And what are the global effects of the financial crisis on the various firms and the real economy per se? So these are the various article related aspects that we are looking at in our current session. Talking about the triggers and vulnerabilities, some of the facts that we already are aware of. There were during the crisis or just before the crisis, there were huge losses on subprime mortgages, and those losses or even the prospect of those kind of losses after the housing prices started a decline. So there was a housing prices bubble bursting, and because of that, lots and lots of subprime mortgages could not be recovered. There were huge losses on them, and that is accepted as the major trigger to the financial crisis. But the volume, the amount is too small to create a global financial crisis. Now, what we are saying is this has actually triggered. This was the initial fuel to the crisis. Because this alone is not the crisis. The prospective subprime losses are not that large enough that on their own they created the crisis. They have only amplified the situation or exaggerated the situation in such a way that it caused the crisis. And if you look at the vulnerabilities, they were occurred. The whole vulnerabilities have come out during the crisis primarily because of the changes that have occurred in the financial sector. The whole financial crisis resulted in a bank run. People were withdrawing the money from the banks. Even the investors were withdrawing the money from the various funds in which they have invested. But not just on the banks, the run was also on the financial institutions which provided bank-like debt products to the institutional investors. So there was a kind of a shadow banking system that came up where various financial entities other than the banks they became intermediaries to channel the savings into investment, and they became the key source of vulnerability. So if I have to understand, the major source of vulnerability was the short-term debt, where we talked about two major instruments contributing to the whole process. One is the repurchase agreements, otherwise called as repos in short, and commercial paper, again more detailed, asset-backed commercial paper, ABCP in short. Repo market has represented the fastest growing component of the wholesale funding market, and that is completely largely unregulated. That's one more reason that contributed as a major vulnerability to the crisis. So looking from a short-term debt, I want to talk about these two instruments. So repo agreements are more like collateralized deposits in a bank, right? I am depositing with an intention, or I am lending, or I am borrowing with an intention to pay back at a later point. Right? It's like a collateralized deposit, because the borrower is borrowing by putting something as a collateral with a promise that he is going to pay back the cash and retrieve the collateral. So these kind of borrowings that are happening by keeping the collateral is what we call as a repo agreement. So the depositor or the lender puts money in the bank for a short term. So the depositor or the lender is actually is actually lending to the bank for a very short term, generally for overnight. And bank is promising that the overnight rate will be paid back to the depositor. On whatever the deposited money, the overnight repo rate would be paid. Now, what is the guarantee that the bank will pay? The amount is too high in this transaction. So, to ensure that the bank is going to pay, to ensure the safety of the deposit, the bank is providing the collateral to the depositor. So, the depositor is having a collateral from the bank, and once the bank pays the depositor back, the collateral will be refunded. So here you will find all kinds of major institutional investors, funds, non-financial firms, states, all of them, municipalities, all of them participating in these kind of transactions. Now the deposit size is too big, the amount that is borrowed is too big from a simple insurance kind of a perspective. That's the reason the collateral is coming into picture. And if the bank is failing, the depositor can very well sell the collateral and recover the value of the deposit. So this is how the typical overnight borrowings are happening within the banks, and even various financial institutions. When they borrow for very short term, they are doing so using the repurchase agreements or the typical repos. The other source of borrowing for short terms for banks and various financial institutions is through the commercial paper. It's an important security for financing of industrial firms for decades. There's a lot of dependence of many companies for over long number of years for raising capital for short-term purposes. Generally, the commercial papers carry a very high credit rating, and the raising of the debt is very quick, especially by large credit worthy kind of companies only. The transaction costs are much lesser for these kind of instruments. They have a very high demand, and the financial intermediaries have made use of the market first to raise capital and then finance these commercial papers. So instead of investors directly buying the commercial papers on their own, they are raising capital from the market and using those funds to borrow. So in that case, we are calling those financial instruments not simply as commercial paper but asset-backed commercial paper. And because of this originate and distribute kind of model, we see that majority of the financial institutions have bundled various mortgages, credit card receivables and other loans into various off-balance sheet vehicles, sold them to the investors through various structured products. And that one of those structured products, and for investing in those structured products, raising capital was done through these kind of various instruments. Various types of short-term debt, you find that during the crisis, they are all subjected to runs. Right? All those investors who have invested heavily in all these short-term commercial papers, especially the money market mutual funds, who are one of the major investors in all these short-term instruments, they all came out as alternative sources of short-term debt, commercial paper, securitized bonds, repos. So this is what we called as a shadow banking world. And this shadow banking world got very badly impacted, and a lot of runs on the institutions typically started during the crisis. So problems got created in the mortgage market and the credit market because of all these shadow banking system, and these problems got spilled over into the interbank markets as well. So which means all the collaterals that were kept, they were demanding more and more collaterals, means the haircuts or the margins on these collaterals have risen quite drastically. And even the asset-backed commercial paper, which was assumed to be the most liquid and most liquid kind of a financial instrument, more easy to roll it forward to the future, even that instrument was facing serious hiccups in terms of rolling it to the next period. So this is where the major vulnerabilities came up, especially with respect to the short-term debt. And during September 2008, the Lehman has actually collapsed. The failure of Lehman on the global financial markets, until the Lehman has failed, the typical industry was thinking of a manageable market turmoil. But once the failure of Lehman occurred, it resulted in a full-fledged global crisis. More and more financial institutions which have had huge volumes of transactions with Lehman, they started facing the risk of default. Lot of major money market mutual funds, especially the reserve primary fund, which has a heavy investment, heavy number of transactions with respect to Lehman, it has completely broke the buck. So various money market funds, they really saw that their values have gone down quite drastically, because on the asset-backed commercial paper, the yields have gone up. The higher is the risk associated, the higher should be the yield associated with that instrument. And because of that reason, here we see that the yields have shot up quite drastically. And the US Treasury has to announce a temporary guarantee. Situation went to that kind of an extreme, where the money market funds have really lost big deals of their values, and the US Treasury had to announce a temporary guarantee of the money market mutual fund. That's one extreme that we have seen during the Lehman's failure. The confidence in the entire stability of the financial systems got completely hurt. another major consequence. And liquidity became a major concern for the banks. They were not willing to lend with a kind of apprehension that they would not be able to raise capital in future at all. So there was a kind of stalling of the entire process that came up. There is hardly any kind of transactions occurring during the period. Banks are hoarding their liquidity, and because the not too much of lending and borrowing activity occurring, all other sectors which were dependent on the banks started getting badly impacted, out of which the real sector got the biggest beating of all the times. So the real sector and even the global markets got badly affected because of this move. And even more and more apprehensions regarding the prospective losses in the subprime market added more and more fuel to the fire, resulting in global financial markets having a big drastic impact. Looking at the crisis, we have already talked about there are bank runs, huge number of bank runs during the period, people withdrawing the money from the banks, investors pulling out their funds, pulling out their amounts from the various funds they have invested in. So because of that, there were closure of so many banks and financial institutions, or in some cases there were some kind of mergers that have happened, or takeovers. We could see so many, even the biggest of the biggest investment banking firms got taken overs. So we have seen all such kind of things happening in the global market during the crisis. Closures, merger, takeovers. In some cases, even the government assistance to these financial institutions came up in a very large manner. So there were so many such kind of outcomes which have really contributed to the crisis, or which have occurred in a long way during the crisis. And if you look at the results of this particular crisis, the external debt as well as the domestic government debt, the debt levels have grown or increased quite sharply. Just before the banking crisis started, you find that the domestic debt levels as well as the international or external debt levels have gone up quite drastically. And the entire crisis of the banking system started moving on to impact the overall country per se, leading to sovereign debt crisis altogether. So the debt crisis had moved from just the banking system to the overall economy. And changes in the credit supplies, the whole credit supply changes, especially the bank loans, banks not willing to give loans because of the fears they had regarding the liquidity in the future. So the whole changes in the credit supply, they indicated very strongly the upcoming financial crisis. Prior to the crisis, if you see the money as well as the credit aggregates, the different kinds of money supplies as well as the credit aggregates, when I am talking about credit aggregates, the sum total of the overall outstanding loans that the banks were having. They were having, in general cases, they have a stable relationship with the GDP. But just before the crisis, these numbers increase quite drastically. But once the crisis starts up, you see that these numbers go much lower and lower. Heavy collapse in these numbers is typically observed, which is also another major result that comes out of the financial crisis. So the acceleration of system-wide leverage just before the crisis. So you find that huge leverage-based transactions occur across the system just before the crisis. So from this also we can very well make out that a big financial crisis is on the corner. So these are some of the things that we really need to be looking at. And during this period, If I have to talk about the two main panic periods, one I say August 2007, where the entire asset-backed commercial paper market, there was a run on it, and this we can call it as the first major event of the financial crisis. So this entire asset-backed commercial program, why did it got into a big run? Because the lenders were unwilling to refinance the commercial paper. So there was a maturity for the existing commercial paper. Generally, it would be rolled forward, which means the borrowings of another new commercial paper would be issued, against which the loan would be, against which the borrowing would happen, and that amount would be used to pay to the existing commercial paper which would be matured. But that refinancing could not get happen during August 2007 when the commercial paper is getting due. So no new paper is coming out even if the existing commercial paper was maturing. That itself is a clear indicator that there is some liquidity problem in the system. The money market funds, their values were going down quite drastically. The asset backed commercial paper yield was increasing higher and higher because there was a lot of unwillingness among the lenders. So even if they were lending, the lending rates were much higher, which resulted in the value of all the assets being held by the money market funds, they declined sharply. So because of this, there were so many asset-backed commercial papers which were sold, where the underlying assets were sold at phenomenally lower prices, and the values have gone down quite drastically, which had resulted in the overall collapse during 2007. So that is one major panic period. But the second, or the most heavy damage, occurred during September October 2008, because to a large extent money market mutual funds which were expected to hit up a big disaster in August 2007 itself, they avoided large runs, but they could not avoid the situation in September 2008. The prime money market funds, they are the crucial suppliers of funds to the corporations and financial intermediaries that you are already aware of. But there was a big move where from the various private funds, there was a move of the investors to government only money market mutual funds. So which means from all the private credit markets, the liquidity got very badly affected, and majority of these money market mutual funds had to be bailed out by the banks, or in some cases the various fund families which have managed them. So that has triggered the whole crisis, that has created a big panic in the United States during the 2008 period, which has accelerated the crisis. So the repo market also, it has got weakened during the 2007, but to a large extent it was able to limp along. But once Lehman failure has occurred in September 2008, the repo market could not recover to any extent. Now, looking at this entire crisis, there were so many government policy responses that have come out, right? The central bank, it has actually come out with some kind of modifications to the monetary policy and the liquidity support. It has resulted in, it has come out with schemes like reduction of the interest rates, came up with reserve requirements, played around with longer funding terms, more auctions, higher credit lines. These are some of the policy related changes that the government has come out with. But some of the few observations from this. So people have tested, or these authors have typically tested the effectiveness of the reduction of the interest rates. And two mechanisms have been used for the test: economic stress index and the financial stress index. Economic stress index consists of various confidence measures, credit spreads. They analyze different levels of confidence measures, credit spreads, and stock prices of non-financial companies to see how the reduction in the interest rates have really eased this crisis, or have improved the situation from the crisis. Also looked at FSI, which is the financial stress index, where we are looking at the same kind of measures, bank credit, spreads, stock prices, etc. of the financial companies. So these were the two numbers that were examined separately to understand whether there was any kind of improvement in the reduction of the interest rates in improving the financial crisis situation. What they have concluded is there was no evidence of short-run impact of the interest rate cut. So decreasing the interest rates did not have any kind of an impact on the ESI, which is the non-financial companies did not get any kind of an advantage by this move. But some amount of positive impact was there on the FSI, which means the banks, they got a slight amount of improvement because of these changes to the monetary policy, where they have reduced the interest rates. Similarly, talking about the other policy changes relating to reserve requirements, funding terms getting longer, auctions, etc. So people have found that interbank spreads have resulted in positive effect. So because of which the FSI, again something to do with the banking system, the various measures of the banking system got positive during the pre-Lehman period. So things were much better off. The interbanking spread has a positive kind of a feel during the period before the collapse of Lehman Brothers. But after the collapse of Lehman Brothers, even this could not show any kind of an effect, which means all the policy changes relating to reserving, funding terms, auctions, etc., they did not have any kind of impact on the improvisation of the situation, because way more and more people started bothering about the solvency compared to the liquidity. So liquidity seemed like a lesser problem after the Lehman Brothers collapse, but solvency looked like a major problem during that period. So all these interbank spreads and all were not able to create any kind of impact. And apart from that, the government also has got into various stabilization related measures, right? You see that there were many instances where it has injected the capital either in the form of common stock, preferred equity, or subordinated debt to various institutions. The depositors' protection got very much enhanced by the government. There were all kinds of debt guarantees to all the investors. Government started lending to various private individual institutions just to bail them out. Various asset purchases, individual assets were purchased by the government, bank by bank, and even bad banks related assets were also purchased. There was a heavy injection of liquidity, especially with respect to bad assets purchases and removals. On balance sheet, off balance sheet, ring fencing has occurred with respect to toxic assets which were kept with the bank or even moved to the bad bank. So the entire ring fencing has been taken care of by the government. It has provided various kinds of asset guarantees. Now, out of all these things, if you look at the areas, so these are more of recapitalization. So these steps, so it has injected fresh capital. So it has done some kind of a recapitalization. If you look at all these things, this is more to do with asset purchase. And you could also see liability guarantees. So if you look at these three broad headers under which the government has provided stabilization measures, we see that the recapitalizations were effective, especially the capital that they have injected. So there were significant improvements in the index of bank CDS spreads, almost all countries. So I could see that the recapitalizations were slightly more effective, but neither the asset purchases nor the liability guarantees have shown any kind of good results, which is a clear indicator that these various activities and the measures that the government has taken has not resulted or has not yielded any kind of short-term impacts to the financial crisis. And the liquidity support that the government has provided during the crisis in the earlier stages, especially when the Lehman Brothers did not collapse, during that time the liquidity support looked like more and more effective, but once the Lehman Brothers had collapsed altogether, the liquidity support that the government has provided looked like a futile attempt. And the capital injections that have happened towards the later stages after the crisis, they can very well be regarded as one of the most effective policy measures that have been taken up by the government. So various steps have been taken by the government as a post response to the crisis, but majority of them could not provide any quick short term improvement in the situation except some amount of recapitalizations being done. Those are the things that have really helped from the crisis becoming even more worse because of the capital injections that have occurred into the process. And this whole crisis have really created many ripples across the various sectors of the economy and even the various countries across the world. People lost confidence in the banking system. Lots and lots of concerns regarding the solvency of various companies, the liquidity of the counterparties in various derivative transactions. OTC derivatives market got badly affected. So all these things, and banks were unwilling to lend, financial institutions were unwilling to lend because of the apprehensions they had regarding the future raising of the capital. All these have really hit the real sector of the economy, and especially after the collapse of Lehman Brothers, after the failure of the Lehman Brothers, we see that the whole real sector of the economy got badly affected. And intermediaries, all kinds of financial intermediaries, they were not in a position to lend. They were apprehensive of the future capital position, future liquidity position. So they were only hoarding cash, so not getting into the lending processes at all. And the syndicated lending, which used to be one of the major aspects until from the beginning of the 21st century to mid 2007. After that, it looked like syndicated lending has fallen quite drastically, and especially in 2008, it became more and more worse. So the lendings almost stopped across all kinds of loans, whether they are investment grade or non-investment grade kind of loans. The lendings have fallen quite drastically. All kinds of loans, not just mortgages, the term loans, credit lines even given to the companies hit badly. The loans that are used for various corporate restructuring activities or even for general corporate purposes or even working capital purposes, all kinds of loans, the lending activity has fallen quite drastically after the financial crisis in 2008. And people observed, or the studies say, that there were some amount of increase in the commercial and industrial loans, but that is not the new loans, but majorly whatever were the existing credit lines that were there, where the pre-committed agreements with the financial institutions were entered before the crisis, the companies and the industries started utilizing and drawing down all those existing lines. So that's where for the initial few periods it was observed that the commercial and the industrial loan have increased just immediately after the financial crisis has occurred. But overall also we see that there has been a big decrease in demand for consumer loans during the process. Even the rejection rate, earlier it was a subprime lending, but now the rejection rate has affected the banks very badly. Now that more number of rejections are occurred, the number of rejections are significantly higher than any of those non-affected saving banks. And even especially for the mortgages related borrowings, the rejection rates have gone up and touched the highest percentages of all the time. So compared to other consumer loans, mortgages got highest amount of rejection rates as well, which again has impacted the real sector of the economy. And finally, banks have also cut back on their credit supply. So the number of loans, the amount of loans that they were lending has decreased quite drastically. Even the demand for credit also has fallen. So all these things really have contributed to after effects of the crisis, impacting the overall global economies as well as the non-financial and the real economies across the world as well. So this is what I really wanted to cover as a part of this session. I hope you might have got a good amount of clarity on these various topics that I have taken up here. In case you find any clarity is required, you can very well get in touch with me by giving me a call on the number that I have given below, or you can send in an email at the email address that I have provided. Thanks a lot for listening to this session. Thank you very much.